What's up, YouTube? Stocks by the numbers. We're getting back into it today with a brand name Dow component blue chip stock that pays us a nice healthy dividend to own it. Company's been around for, 70 years. Name of the company we're looking at, McDonald's Corporation, ticker symbol MCD, listed here on the New York Stock Exchange. Stock right now trading $282.02 a share, down just 26 cents, relatively flat here on the day. And I wanted to look at this stock because I feel like it's kind of a mixed bag, because I feel we have a lot of indicators showing us that we could continue to keep rising, and we also have some indicators telling us that a sell-off may potentially be due. Now, a lot of the recent headlines here, McDonald's hitting new highs and all this nonsense, if we stretch out, there's a 1 month chart, as you can see here, really just up and up, going from 260 to about 285 there, breaking above that top fib. And if we stretch out even further, you can see even 6 months ago, this stock was down in the lower 200s. The company usually comes in with some healthy EPS and revenue numbers, and they consistently beat earnings more than not. I drew some long-term trend lines here, but there's a 1 year chart, and just backing up here, you can see, just look at the way, obviously, we had a massive pullback there, pandemic, and then, of course, it just rebounded and has kind of just been riding high. And this stock, everyone will basically be bullish on this company, right? Because, again, it's a brand name stock. Everyone continues to go to McDonald's, really, regardless of what is going on. And I see a lot of videos and a lot of posts and a lot of news articles talking about how McDonald's is recession-proof, right? And I'd say several years ago, when we went back to, 2000, 2001, market pulled back, economy was in a rough time, I can understand people going to McDonald's. Even in 08, 09, housing market crashed, looms of a recession, I can understand people going to McDonald's. Nowadays, though, I got to be honest, the last time I went to McDonald's, I feel, in my opinion, it is no longer worth it. Somehow, this franchise, with the most number of locations, right behind Subway, I believe, who always had the value menu, the dollar menu. We're always keeping it nice and cheap so that you can get, a couple of burgers and fries and a drink for the same price as, just one or two items at another location. So that's what made them so attractive. But nowadays, I don't know if you guys have been to a McDonald's recently, but in my opinion, the prices have really gotten out of control. And it gets to the point where if I can just get one or two items at McDonald's and it's basically the same as, a decent meal that I can make for myself at home, then what the hell is the point of going to McDonald's anymore? It is no longer recession-proof, in my opinion. Plus, on the flip side, going back to the number of locations they have, you compare them with another burger franchise like Five Guys, and you're basically spending the same amount of money, which should not be the case at all, in my opinion. So, I'm sure a lot of people are going to jump on the bandwagon for McDonald's and, try to tell us that they're bullish on the stock. And again, as we look here, over all of these decades, the stock is kicking ass and taking names. They've been consistently paying out dividends to shareholders and increasing it consistently. Now the company is yielding 2.15%. to own the stock. 2% of 282 is about a little over $5 a share. So you're getting paid to hold shares of the company. The PE, again, consistently increasing, sitting here a touch below 34, which in my opinion is pretty damn high, especially for the sector that the company is in right now. However, on paper, you can't deny some of the beats that this company's bringing to the table. Now, they have been talking about a lot of layoffs, corporate layoffs also. And if you went into a McDonald's recently, now there's kiosks, and you can basically do it, without any social interaction. You just touch a screen a bunch of times and you can get your order. So if they're trying to autonomize the entire industry, see, this is what blows my mind, because if you're going to autonomize the whole industry, now you're no longer having, any payroll expenses, really, and you don't have to pay for people's health care or whatever the health benefits you get at McDonald's, right? So if you're replacing them with machines, yes, the initial cost will be great. However, over time, your returns are seriously going to start adding up hand over fist. So you would think that prices should go down. However, that is never going to happen because we live in an inflationary economy. So, McDonald's could actually get all of their goods for, $1 across the board, and they're still going to charge $9, $10, $12 because inflation is going up, and they can. And basically, the average person will pay for it. But let's get into the numbers here. Enough theory. Market cap $206 billion. We'll call it again almost 34 times earnings. A little expensive. Company beat on the EPS side for the last 4 quarters in a row. If we switch over here, looking at the revenue, we are kind of bouncing around here. $6 billion down to 5.6, 5.7, up to 5.8, up to 5.9. So the last 4 quarters, they have been increasing. And, of course, the profit margin has made a massive jump, going from, I'd say, the low 20s up to the low 30s. So the more profitable a company is, the higher they will drive the stock. But switching over here annually, again, I'm kind of seeing a little bit of a mixed bag because, again, we could say revenue has increased. However, we can't really, tie that into an increase in customer base. Right? We have to assume that happened due to a rise in prices. And of course, the whole country was shut down, so everyone was paying, 20-30% extra on Grubhub and Uber Eats and DoorDash to get their McDonald's brought to them. This was one of the few companies that were initially doing well. However, remember, you gave people free money. So people, if they don't have to work for their money and then they want to spend their money, they're going to do it in the most lackadaisical, convenient way, which is why we saw a lot of revenue coming into, Domino's and McDonald's and places like this. But right now, as we see, going from 21 to 22, the revenue has actually dipped down from 23.22 to 23.18 billion, along with the profit margin taking a drop down. Even though supposedly for 2022, the company is still looking pretty healthy on paper. But if we look at the financials here, we're breaking it down here. Okay, see, this is interesting because if we look at the revenue estimates for the last 4 fiscal years, you can see the company has missed 2 out of 4 of them. However, just consistently keeps climbing higher. And a slight beat here in 2022, as we see, 23.18 above estimates of 22.99. However, this year, 2023, estimates have jumped to 24.32 billion. So if the company is kind of potentially plateauing here at the 23 billion mark, this company may come in light for the year of 23 and come in with maybe like 23.5, 23.8 billion. Again, citing, inflation, and also the fact that these places really stopped doing deals. You notice that? You used to see the commercials all the time. It's like, oh yeah, 2 sandwiches for $5, 2 for $6, or whatever. It's like they all stopped doing that. It's just occasional here or there. They kind of redid. I don't know where you guys live, how your locations look, but here in New York, they kind of redid all these locations. Now they kind of look like upscale, yuppie Starbuckses. And it's supposed to be just like some little burger joint to go in and get a cheap meal. And now it's, it looks like a little too feng shui for me, if you will. But, we got our touch screens going on in there. I don't know. It's just not adding up to me. And I actually think they're trying to do too much with how far they've come and how much they established themselves. I really think, in my opinion anyway, they need to go back to their roots, but they're kind of going down a different path here. As we look here on the EPS side, again, it's amazing how this company consistently grows, and people talk about how it's recession-proof because this company has missed on the EPS side 3 of the last 4 years. And yes, 2022 was a little bit more profitable. And again, adding on to the layoffs here, apparently if every company is laying people off, so obviously that is going to bring up the profitability ratios a couple of points. So it's understandable as to why this company will probably remain profitable in the short term. But again, we see the dividend history, 2018, $4.19 a share, up to $4.73, $5.04 a share, $5.25, now paying $5.66 a share. So this is what I talk about also when we talk about compound investing year over year, doing the DRIP, of course, DRIP, which is the dividend reinvestment program. So every time they pay you dividends for owning the shares, you say, no, don't give me the cash. Let me reinvest it into more shares. And then the next time you get dividends, you get even more because you have more shares from the previous dividend. So that's compound investing really in a nutshell. However, we can see the debt has ballooned up since 2018, going from 31 billion up to about 50 billion. We can call it slightly pulling back 1 or 2 billion in the last year or two. And of course, the company is holding several billion in cash on hand, which is always a good thing. But it's interesting because if we come over here, we've looked at a lot of companies on this channel, and a lot of these companies, even though they're struggling, kind of still in their infancy, beginning to bring in some revenue, what we're seeing is the asset worth that they're holding on their balance sheet are kind of maintaining a certain company value for the stock, right? And we're seeing certain stocks not completely fall off cliffs because they're holding, several $100 million in assets on their balance sheet, and the assets are outweighing the liabilities. However, in McDonald's case, we have the opposite of what's going on here. As we see here in the short term, 5.42 billion in assets, 3.8 billion in liabilities. But we switch over here to the long term. Now the company has 45 billion in assets, 52.64 billion in liabilities. So now liabilities are outweighing assets, and debt has risen. Debt has basically risen for several years, and again, even though it is slightly pulling back, it's kind of maintained this $48-49 billion mark. So, again, I understand that the company, I guess you can say, beats earnings more often than not, and they always come out with some BS positive announcement, and anytime a board member is changed, it's always a positive reaction. It's never a negative reaction for a company like McDonald's. However, looking at the total revenue year over year, you can see in 2016 the company was really rocking and rolling, bringing in 24.6 billion in revenue, and has not gotten back to that point even with supposedly recession-proof business and increased number of customers, supposedly because money is tight and everyone keeps going to McDonald's, right? This is what they try to tell you. And of course, across this whole time frame for the last several years, they've also been trying to move into autonomous employees, if you will. So the fact that they really haven't even recovered from 2016 is kind of raising a red flag, in my opinion. And we kind of see this consistent decrease, 16, 17, 18, even 19 wasn't really crazy. 2020 we can understand, right? That's when everything got locked down. So I understand revenue went down for a company like this. However, on the flip side, if you recall, before the pandemic, everyone was a very health conscious. People were more aware of the food that they were ingesting. And if you recall, this is really kind of when everything started taking off. Everyone wanted like soy shit, and these companies tried to move into plant-based burgers and whatnot. But it was also the chemicals, and people wanted everything organic and farm to table, no antibiotics, none of that shit. And obviously, the opposite food of that is fast food that is mass produced, right, for a cheap price. So that's why I think, in my eyes, we may have seen this decline here in the overall business over these several years. And then again, with the stimulus money coming in my eyes, plus the fact inflation, this is why this company, I feel, has ballooned back up to 23 billion. Now again, obviously for 23, revenue could jump back into the 24 billion range, and I can be proven completely wrong. But again, as I said before, the way prices have increased, the last time I went to a McDonald's, I mean, you can actually go to the supermarket and get a serious meal, a nice meal for yourself, for the same price as, like some BS value meal from McDonald's. Or now, because they got rid of the dollar menu and now they call it the value menu, even though it's really not a value because everything on there is like $3 now when it used to be, like $1. So you get 2-3 items, and you're basically spending the same as you would for, an entire pork roast and a bag of potatoes. So it's really not worth it. I understand the laziness factor, but believe me, when it really comes down to looking at your dollars and your cents, it's not the best idea to go and spend it at McDonald's. And I think that's what we're seeing here. The profit, again, has increased. They have increased the profitability. The cost of goods sold, again, was significantly higher, even though they were doing more revenue. And now about 1.5 billion off of the high, however, saved about 4 billion in cost of goods sold. So this is what I'm talking about. The operating expenses too climbed up to 2.74 billion and have slightly been pulling back now at 2.67 billion. So, they are working to increase their profitability ratios, and it could help the company overall moving forward. However, I just feel the overall business is going to start suffering. If we switch over here to the balance sheet, you can see the company jumped up from 31 billion to north of 50 billion in assets here, maintaining 50.44 billion in 2022. However, again, liabilities are outweighing that, 56.44 billion. And again, we've looked at companies where assets to liabilities were like a 2-to-1 ratio, right? That's a pretty healthy ratio that we've seen, or maybe at least 1.5 to 1. This company is -1, meaning below 1, not -1. But it's a minus, it's below 1 ratio here, with the liabilities now outweighing the company's assets. So again, I'm kind of surprised as to why they continue to climb this up here. Even the debt has climbed up. Again, we looked at it here to 50 billion, and look at the book value per share, -$8 a share. Reason being is because if the company did have to close its doors and liquidate, all of the main assets, the first call for the assets goes to the preferred shareholders, right? And this value here, there you go, Steam Friend, playing some CS, but this value here, see, this is interesting because the book value per share shows a company's book value per common share outstanding to the fiscal period. Book value, also known as net asset value, or NAV, which is what you see when you look at a mutual fund. NAV, supposedly price per share. That's, how they do it with mutual funds. But anyway, represents the difference between total assets, total liabilities, excluding preferred stock equity, because preferred shareholders have higher rights on assets and earnings than common shareholders. So if you were not aware of this fact, just because you own shares of this stock, common shares most likely, and you're getting paid a dividend to own it, does not mean it's first come, first served for you because you're involved into the stock. The preferred shareholders, which is why they have that term, they are preferred, and if the company does have to close its doors and liquidate, they get the first dibs. They get their value back before all common shareholders. Then whatever is left has to be potentially split up amongst, think about how many common shareholders there are, and that's why, God forbid, if you own the stock and the company does shit the bed and go out of business, you're kind of going to be shit out of luck. So this negative book value per share is very, very interesting, because as we see here, it has always been negative. And the company is trading $282 a share. Now look, my point here, looking at this, is not the fact that McDonald's should be $10 a share. I'm not going to go that far. However, if we're looking at some of these negative metrics rising, and then I sit here and tell you that this stock should pull back to like 200, you kind of can't call me crazy for seeing it that way. The cash really has been bouncing around, as we see here. Cash from operating activities maintaining about that $7 billion mark. Has been higher at times, but of course was coming off the mid-5s and low 6s, so 7.3, not too bad. Cash from investing and financing is negative, and again, the company's sitting there with about $5 billion in cash flow. But moving over here to the statistics quickly, we can see the PE close to 34. That is the second highest it's been, going all the way back to 2016. That's why I'm saying the company may be due for a sell-off. Just consistent increases in value year over year. Now the company's trading 9 times sales when it used to trade 4 times sales, 28 times cash flow, when at one point it was down almost half that, and was really in the low 20s here, and now just jumped up to the high 20s. Obviously, book value, price to book ratio is non-existent, since book value apparently is negative. However, to buy the company out, which is the enterprise value, they have it listed at $252 billion, with the company currently at what do we say, like $200 billion. So that's pretty interesting to me. However, as we see here, comparing this enterprise value to the EBITDA, earnings before interest, taxes, depreciation, amortization, you can see trading over 20 times the EBITDA ratio, which technically is the second highest it has been over the years. And 2020, when they really had a pullback, was when it was climbing to its highest point. So that's why, coming back up into these 20s, we may be ready for a sell-off. The return on assets has been bouncing around, has since pulled back year over year. No return on equity. Return on invested capital we saw has been pulling back, was negative. The gross margin percentage, this is what I'm talking about on the profitability side, was low 40s, jumped up to low 50s, and now in the mid to high 50s, even though it did have a slight pullback here, it's still sitting here at about 56%. The operating margin has moved about 33%, going from the low 30s sitting here to the low 40s, with again a small dip from the previous year. And EBITDA, again, earnings before interest, taxes, depreciation, amortization. I think I just like saying it. But here you can see it was down in the high 30s, low 40s, and then now jumped up into the 50s. However, a slight pullback from the year before, sitting here now a touch below 51%. And the net margin percentage we looked at before really jumped up, going from about the 20s on average, jumping up now into the low 30s, sitting here at 32.12%. The inventory turnover, which we have been looking at, again, has ballooned up to 200 plus on several occasions. However, seems to be slightly pulling back with a tiny increase this year from last year. And again, here, see the debt to assets ratio here is sub 1. Debt to equity is negative. And long-term debt to total assets, again, sub 1. This is what I mean. We have seen bigger and better things here on this channel. However, the company does consistently pay out to its shareholders here, increasing its dividend year over year like clockwork. As you can see, paying out roughly 68% to shareholders. So that's why I'm saying it's really kind of a mixed bag here with McDonald's. But overall, I do feel, in my opinion, they're ready for a pullback. Still anticipating bigger and better things moving forward into 24, 25, and 26. Consistent growth year over year on the revenue and EPS side. Obviously, only time will tell for that. And this is a quick breakdown of the revenue. But before I let you guys go, this is an all chart. This is the top line and the bottom line. You can see basically just a straight upward channel here. Those are the blue lines. If we zoom in here, this is going back from right before the crash in 2000, 2001, and you can see that high here drawn in the yellow line, and the low here going to 03 drawn up in the yellow line, and you can see that is basically forming a tightening, rising, ascending wedge, if you will, indicating we may be ready for a pullback. And then if I zoom in even further, now we're going to the pullback here in 2020. And you can see this is the height of the trend line, and this is coming off the low, the trend line here in orange, and you can see again kind of forming an ascending wedge. So this is why I'm saying, on paper, you can say technically the company is due for a pullback, and now looking at the technicals, you can see we have ascending wedges inside of ascending wedges. So again, I do feel a breakdown may be imminent here. However, I have to give the company credit, because aside from these massive market pullbacks and big turmoil we dealt with during these years, you can see going all the way back almost to inception, this company has really been staying above and bouncing off of this simple moving average. So, you know, that is why, again, you know, there are reasons to say that they should pull back, and there are also indicators saying that it's not going to stop here at 282, and it's going to get to, 302, 322 before it pulls back. So, again, kind of a mixed bag. However, looking here at stock charts very quickly, we can see the RSI has now risen up to 70. The company has been absolutely rocking and rolling for about the last 3 weeks. So, again, that's adding to why we should have a pullback. We had a rejection here off the top Bollinger Band, and almost closed at the low, which would have formed a bearish hammer, which definitely would have indicated that we were pulling back. However, you know, back to this 50-day moving average 268, I do think it's possible. And even down here, this 200-day moving average 259, that is more realistic and where it should be, in my opinion. The MACD was rising again along with the stock, however, may be potentially plateauing, about to curl downward there, prepping us for the sell-off. Switching over here on the weekly, again, the RSI has risen, sitting here at 63. Not the highest we've seen, however, you know, as we see here over the years, when it does touch that 70 benchmark, it does usually pull back. So this is why, again, I feel that a pullback will happen here with McDonald's before another like higher potentially. This 50-day moving average 256.83. The other moving average was like 259. So that's why I do feel it is possible. And of course, you know, not to be the bearer of bad news, but with a 34 PE, liabilities outweighing assets, some of those revenue numbers kind of bouncing around, I do feel a pullback to 220 is actually justified. However, I seriously don't think it's going to happen, as it has not been there really since early 2021. But technically, it should be there because, again, they're pumping it up, making it seem like it is this rock-solid, unstoppable recession stock, and I'm telling you, it is not. Go to a McDonald's, look at the prices, and I'm telling you, you will much, much rather, make your own meal or take your money elsewhere and get a bigger bang for your buck, especially in this economy. As we see here, the stock topped out here at 284.98. And we can see the next pivot point, looking at the weekly here, is 289.72. That's why, again, you could make the argument for each way. If it goes up to 289 first and then rejects, understandable. If it drops immediately, understandable. Over here on the daily, again, your pivot point is 286.71. So that's what I mean. It could go a couple of dollars higher before it takes a pullback. However, looking at these pivot points here, down 260 again, this moving average 259.5, we'll call it, and then down here at roughly 253.25. That's where, in my opinion, the company really should be heading. So, I do like McDonald's overall. They do still pump out decent numbers. They are increasing profitability, and apparently more people feel like it's the place to go. However, I do feel like they do have a little bit of a rocky road ahead of them. So right now, with these high multiples, the stock at 282, I personally would not be a buyer. If it does have a slight pullback, we'll call it 10%, and come down to 252 instead of 282, I would absolutely come back, reevaluate the stock, and consider taking a position at that discount. But here at 282, I personally would not be a buyer. But I'll end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, please drop it down in the comments section. I'm usually very quick to reply. If you agree, let me know. If you disagree and think I'm crazy, let me know that too. But like everyone on YouTube says, like the video, thumbs up, helps out the algorithm. It's all YouTube cares about. And subscribe to the channel if you haven't yet. That would mean the world to me. I love seeing the community grow day after day. But moving forward, like I always say, I understand that these markets are rocky and they're volatile and they're uncertain. So I want to wish everyone success. I hope everyone makes a couple of dollars. Thanks for stopping by. I'll catch you guys in the next video.